Hey, good morning, everyone. Hello.
Morning, Professor.
Yeah, good morning. Good morning. How are you? Good
Good
morning,
morning.
Carolisk. Good morning. Um, Morning, Angelica. Let's see. Uh, I have like 10 people, right? Currently uh, in the collaborate session and in the forum. Let me check. Before the last time I checked, which was right before I joined the collaborate, there were 9 people. Okay, so again, um, if you're in the collaborate, but if you don't sign into the discussion board, your attendance is not validated because there's no physical proof of your attendance. Now, I don't think I'll have to repeat that over and over again because it's been already, this week is like eighth week. This week is like eighth week, and we have 14 weeks per semester. So, um, and as of, I believe this week is eighth week, right? So more than a half, we are even past the half point. So by now you should be, familiar with the class protocol. Now, so in our last class, oops, not this one, in the last class. First, let me quickly check. Oh, what's going on? So I think we are pretty much done with the financial statements. But just to make sure, let me check. What was the last thing we were talking about? Actually, the by main lecture, as of today, we are done with the topic 3, time value of money. But we're still, dragging on in the collaborate because collaborate is, uh, it's reflection, review. So it's bound to be, it's inevitable that it's behind the main lecture. And so our last discussion was, so I hope you are following up with the these live session recordings, because the last one was on the 19th. And especially if you missed the class, it's all there, and you can't say, I didn't know because I missed the class.
How's everyone?
Okay, so here.
Yeah. Mountain would have, like north faced.
Oh,
the other categories we're not going to talk about it in this class, but it's the topic for total assets is slightly greater than total capital because of that, short-term liability part, right? Okay, so our time is up. That's it for today.
So that was our last class, right? So we finished, we discussed, how from the firm's perspective, from the company's perspective, how they measure the return on investment, right? Um, so it's a kind of micro view, and the measure of return on investment from the firm's perspective is, return on either return on equity or return on total assets. And so let me also pull up my whiteboard and
the screen's not on, Professor.
say that again. Oh, my screen is not shared. I'm sorry. I was totally okay here. What am I doing? Okay. All right. So, all right. My screen is shared now, right? There you go. And this is let me. Okay, now it is too small. Somehow I can't even see. Okay, slightly. Okay, 50%. And there is vast white space, so it's okay. I can I can start anyway. So in our last class, I have to. All right. From the firm's perspective, right? Return on investment is measured by either or return on equity, right? Return on capital, return on assets, total assets, right? Or return on sales. But we were looking mainly at these two, right? And although return on capital and return on sales are also important ratios. They are relatively, not less. They are not relatively less important. But what I'm trying to say is that they are not the most representative, right? They are not the most representative. These are return on equity and return on assets are most representative. And I said last time, it is we use earnings after taxes for return on equity calculation, and this is equity at time 0, and this is EAT, net profit, at time 1. And return on assets, we use EBIT, right? This is more appropriate for return on assets, and total assets at time 0, right? Now, again, the reason for this difference is because the net profit, EAT, belongs solely to the owners, right? In other words, the equity holders. And from equity holders' perspective, this is because this is the fruit, EAT. The net profit is the fruit of their tree. Equity is the tree. Think of it this way. I've been telling you, a firm is nothing but a vessel. Isn't that right? A firm is a vessel. Vessel for what? Channeling and funneling and channeling the profit to the owners, right? So think about it. Size of, I said this before, size of the firm is basically determined by and defined by the size of the total assets, right? Because the size of the total assets defines the production capacity. You understand? Because the size of the total assets will define the size of the fixed assets, such as plant and equipment, right? So the bigger the total assets, the bigger the size of the plant, the size of the firm, right? The bigger the size of the plant and equipment, the bigger the output, right? The bigger the output, the bigger the sale. The bigger the sale, the bigger the revenue. And the bigger the sale, the bigger the market share, right? The bigger the market share. So no wonder, the largest firm in the industry will be the number one player in the industry, right? Because they take up the biggest market share, right? And therefore, from the total asset, think about it. Total asset size defines the size of the company and the size of the production capacity. And where does the total asset come from? We all know total assets come from two types of capital, and there are only two types of capital. Isn't it right? Anyone can tell me what are those two types of capital? Anyone can tell me? Can anyone tell me what are those two types of capital? How come everybody is so quiet?
Professor, isn't it?
Yeah, Angelica, yeah.
Isn't it finance and wait, is finance one of them?
Look, finance means you are raising capital. Finance means you are raising capital, right? So that doesn't that isn't the answer to my question.
So debt and I know it.
Yeah, Angelica, debt and equity, yes. Angelica, debt and equity, yes. There are only two sources of capital, debt and equity. Yeah, Angelica, you got 0.25 points for that. Okay? Yeah, in other words, total assets came from either debt or equity. A better way to say that is, combination of debt and equity. Some combination of debt and equity. So that combination, that combination, or that that mix, right, of debt and equity is called capital structure. I've been telling you, capital structure. The goal of the balance sheet is to explain the capital structure. In other words, how much of the total assets came from equity capital and how much of it came from debt capital, right? So that's what the capital structure means. So it could be, like 60% equity, 40, then that means 40% debt, right? If the 60% of equity, 60% of the total assets came from equity, and then the proportion of debt will have to be 40%. There can be, no other way around. There can be no other way around it, right? If the 70% of the total assets came from equity, then that means debt is 30% of the total assets, right? That's capital structure. And depending on the capital structure, of course, first of all, the profitability can be different. And then, Of course, the higher the leverage means, debt ratio. Debt ratio means what percentage of the total assets came from, what percentage of the total assets came from. So let me write it here. We all know total assets came from why am I doing this? I have a I'm still I'm still drawing with the mouse, although I have I'm just being careful not to poke a hole on my screen with a ballpoint pen because I have to the stylus that I have is actually a ballpoint pen and the rubber tip, so I'm being very cautious not to accidentally pop the ball tip out and poke a hole into my screen. Yes, total assets came from debt and equity, and if equity is 70%, and that would have to be 30%. That goes without saying, and this is called the leverage. Okay, how much debt you use, that's called the leverage. It's also called debt ratio. It's exactly debt ratio. Isn't that right? How much of that is total assets is debt? So it's only natural that it's called debt ratio. Right? But then obviously you can call this equity ratio. And they are complementary, isn't that right? If debt ratio is 30%, equity ratio would be 1 minus 30%. Or, I can write, equity ratio is then 1 minus debt ratio. And then debt ratio is also equity 1 minus equity ratio. It's obvious. Now, think about it. EAT, net profit, is the what am I doing? EAT is the fruit. Finally, it's the fruit, final harvest of the vessel, the means of production. And what's the means of production? Total assets. So you can think of total assets like you can think of it as a tree, right? A fruit tree. And then basically, so you bought this tree. You bought this tree with 30% debt and 70% equity, meaning there were shareholders, right? Investors, shareholders, who invested in this tree. You basically pulled the funds from the shareholders, equity holders. And if the tree is $10 million, I mean, that's hard to imagine, but let's say the tree is $10 million. Then you raise the 7 million, right, from the investors, right, equity holders, right, like you. So there's 7 million came from the stockholders or shareholders or the equity holders, and you borrowed the other 3 million from the bank. So you bought this tree. Now the purpose of tree is to bear fruit, isn't it right? The purpose of the tree is to bear fruit. So 1 year later, at harvest time, the tree bore fruit, right? Whatever fruit it may be, like 1 million fruit, 1 million fruit, right? Let's say the fruit is sold for $1 per each, right? Each fruit sells for $1. So that means let's say 2 million fruit, 2 million fruit, right? And each fruit is sold for $2 million. I mean $2. Then total. Then what is that? That is those 2 million fruit or $2 million is the EBIT, right? Now you understand why EBIT has time subscript of 1, because it's the fruit 1 year later, right? That's the output 1 year later. Now total assets time subscript of the total asset is time 0. You understand why? Because you bought this tree 1 year ago, right, at time 0, and the tree bears fruit 1 year later. So obviously between the value of the total assets, I mean, you paid $10 million at time 0, so the total asset value is 10 million as of time 0. But it bared 1 year later, so the EBIT will be, right, times at time 1, right? That's the operating profit. So that's the fruit. 2 million fruits, 2 million fruit, and because each fruit is selling for $1, total value, dollar value is 2 million. But then think about it. This $2 million worth of fruit, 2 million fruit, is the output of the workings of the combination of both debt and equity. In other words, 30% of that, that 2 million belongs to, I mean, that's the result. 30% of the fruit is the result. That's thanks to that owes to the debt. Does that make sense? 70% of this output owes to the equity, right? But 30% owes to the debt. So you'll have to pay, interest to the debt holders, right? That's why it's earnings before interest and taxes. So you have to pay interest. I mean, you may need to pay principal as well, but we're just assuming that this is because I explained this before. There are two types. If it is bond financed, if it is financed by bond, right? Remember, bond is in case of bond, you don't pay back the principal until maturity. Until maturity, until terminal time, T, right? Until terminal time, you pay only interest, right? And then only at maturity, right? Only at maturity, you pay the principal back, right? That's how the bond works. If it is a loan, right, a regular form of debt, until maturity you amortize. you amortize until maturity. And what does that mean? In amortization, in like monthly installment, right? In every monthly installment, right? You have, so like, monthly installment. It could be monthly or quarterly. I mean, just because I said monthly, it doesn't have to be monthly only, right? In monthly payment, or it could be quarterly, it could be annual, or it could be semi-annual, but normally it's monthly. In monthly payment, right, which is a fixed amount, right, or constant. Oh, it will have to be always the same amount every day, constant dollars, right? And monthly payment breaks down into interest and principal, right? But it's partial principal, of course. And early on, they are not in the same proportion, right? Because early on, I must have talked about this, but I just don't. Sometimes everything is duplicated because early on, interest is, if this monthly payment is like, let's say $3,000, whatever it may be. It's not in the same proportion. Early on, a lot of it is interest, and a small proportion is principal. But as time goes on, interest gets smaller and smaller, and principal gets bigger and bigger, which means if the monthly payment is, let's say, 3,000, let's say it is 3,000. Let's just make it easier, 500. If the monthly payment is 500, then early on, the interest is like, 450. Principal is like 50. But then interest, in the second payment, this becomes 440. This becomes, 60. The third payment, 430, right? 70. So that's called amortization. And so you are in amortization, you are making both interest and principal payment, right? Payment of both. And then by the end of, let's say time t, right? At time t, the terminal time at maturity, interest is very small, and most of it is principal, right? It will be like, 4 490. Then this will be only 10, right? In other words, it's structured that way. Okay. Now, since there are two types of, how you pay back the debt. If it is bond, it's only interest until you pay only. Oh no. Where did it go? Yeah, you pay only interest until okay. That's why You pay only interest until maturity. That's why EBIT, right? That's why it is EBIT, right? Of course, what is not uh, but although it is EBIT, right? It is called EBIT. That means previously in the operating expenses, uh, if it is amortized, if there is a loan that is amortized, the principal repayment is already included in the expenses. That interest is only for the bond. So anyway, the point is, yeah, EBIT is the appropriate measure of profit for both equity holders and bond holders, especially for the bond holders or the debt holders, right? Makes sense because the tree was not bought only by equity. The tree was bought by both the combination of both equity and debt. So the debt holders have 30% claim to the fruit of the tree. Make sense? So and then also so we assume that the fruit the tree bore like 2 million fruit. So in dollar value, it is $2 million. And then after, in those $2 million, there's interest that must be paid out to the debt holders and the taxes to be paid out to the government. And after paying out interest and taxes, then it becomes EAT, which is net profit. But then it belongs to the shareholders or the stockholders or the equity holders only. Equity holders. But since this belongs to both, debt holders, equity holders, and both, right? This is a relevant return on asset is a relevant measure of the profitability from the debt holder's perspective, whereas from the debt holder's perspective, return on equity it is irrelevant to them. It is only relevant to the equity holders, right? So that's why in return on assets you have to use EBIT, right? For that measure, for that ratio, and for return on equity, it is EAT. It has to be the now next question. So then we need to find all this. We need two balance sheets, right? And one income statement. I've been telling you. Two balance sheets, right? Balance sheet at time 0 and balance sheet at time 1, right? And during this time, what explains, income statement explains what happened during time 0 and time 1, right? So here, we all understand that in the balance sheet, right? In the balance sheet of where is it? Okay. Balance sheet at time zero will show you this, basically the composition of debt and equity, right? Equity at debt at time zero and equity at time zero, right? And that will give you total assets at time zero, right? And then the balance sheet at time one will show you, of course, debt at time one and equity at time one. I mean, think about it. It will show you the breakdown, and there will be a change, right? Between year one and year two, there will be change in debt. It could have gone up or it could have gone down. Okay. Change in debt. You know that delta means delta is a symbol for change, right? Change in equity, right? Of course. And then at the end of year one, we will have total assets at time one. Okay. Now, suppose, so this tree, so in our example, I used tree example, and if this tree bore, 2 million fruit, and let's say, after paying out interest and taxes, then 1 million fruit is left. That's $1 million, and $1 million belongs solely to the equity holders. Okay. Now, and then that 1 million. So think about it. At the beginning of time, in other words, at time zero, let's say equity at time zero, total value is 7 million, because that's what we, now this will make our calculation a little, I mean, yeah, it won't be, I'm using only the round numbers, so it won't be that difficult. But think about it. This 7 million was raised by, let's say, so obviously this 7 million was paid in by the shareholders at time zero. And the shareholders at time zero, they are the original investors, original stockholders, right? Think about it. When company sells stock, the stock is, if the stock is sold for the first time, then the stock moves from the company to the first round of buyers. Isn't that right? That's called the primary market. And after that, the stock only changes hands between one buyer to the next. Make sense? Stock is not sold, by the company all the time, right? Stock is sold only once. That's called, if the company sold the stock to the public for the first time, that's called IPO, initial public offering, right? And if you bought the stock at IPO, it's called primary market. and you bought the stock from in the primary market, that means you bought the stock directly from the company. And then after that, every transaction happens in the secondary market. That means in the secondary market means the stock only changes hands between investors only, not between the company and the investors, right? You understand? In the secondary market, it only changes hands between the investors. So, and the company doesn't sell stocks, like anytime they want. No, they can't, because the stockholders don't want it. Stockholders don't want that. It's like, why? Think about it. If you have, if you are one of the owners of the tree, right? Do you want the tree? Do you want this, company that manages the tree to sell more stocks to other buyers? Currently, this tree, the company that manages this tree sold, let's say, 1 million shares. Right? If they sold it, and this is number of shares outstanding, right? Of course, number of shares, right? So think about it. If you divide the total equity raised, right, by selling shares, you divide it by number of shares, then we know each share is then $7, right? $7. And that's called what? That's called the book value per share at time 0. Book value per share at time 0. Okay? Now, and if you are one of these original shareholders, you don't want the company to sell more shares, right? Unless, I mean, if there is, they're selling another 1 million shares, and if those another that another 1 million shares, those 1 million shares are still sold for $7, no problem. But then think about it. If another 1 million shares are sold, but there is no demand for 1 million shares, what's going to happen to the stock price?
It's going to go
Anyone can
down
answer?
because
Yeah, it
not
will
you're
go
flooding the market
down.
with shares.
It will go down. Yeah. Who said that?
Brandon.
Brandon, I'll give you 0.25. Yeah, the price will be diluted, right? The price will be diluted, and nobody wants, existing shareholders don't want that, so they can sell shares, at their whim, right? The company cannot sell shares at their whim like that. So, but think about it, and then. And then, so the number of shares will still remain 1 million, even at, but during this time, at the end of year 1, you have net profit of $1 million, $1 million, right? And this $1 million, in terms of nature of capital, what does that mean? In terms of types of capital, this 1 million net profit, what type of capital is that? Anyone? What type of capital is this net profit? Anyone? Listen, there are only two types of capital, isn't that right? There are only two types of capital. So EAT, net profit, I mean, that's profit. But in terms of capital, what type of capital is that? We're running out of time, so I'm not gonna wait. It is in the nature of capital, it is equity, right? It's equity. Why? Who does this 1 million belong to? I think you can at least answer that. Who does it belong to? Who does this 1 million belong to?
It
Anyone?
belongs to the shareholders.
Yes. Who said that?
Jody and Turner.
Okay, Jody Ann. It belongs to the shareholders. You got 0.25. If it belongs to the shareholders, so what is the nature of the capital then? It belongs to the shareholders, and shareholders are the owners. If it belongs to the owners, what is that? Is it there are only two types of capital, equity or debt. So is this equity or is it debt?
It's equity.
Yes. And who said that?
Jody and Turner.
Okay, Jody Ann, another 0.25 on that. Yeah, it's equity. It's equity. That means, first of all, this 7 million is paid in capital or paid in equity, because it is when the company sold the shares, the first round of buyers bought it, so the capital was paid in as paid in capital. But this 1 million is not paid in. This is equity generated by the operating activity of the company. In other words, it's internally generated. It's not paid in by the outside operating activity. It's not paid in by the outside investors. It's generated by their operating activity. It's equity. Then think about it. If you divide, because it belongs to the equity holders, if you still divide it by number of shares, which is 1 million, what is, we know the result. The result is $1. The result is $1. If you divide it, the result is $1. I know we have. And this $1 is called earnings per share. Earnings per share at time one. Isn't that obvious? Shouldn't it be called earnings? Means it's profit. Per share means literally you divide it by total number of shares. I mean, if you say per, then you divide it by something. Per share. This means that's earnings per share earnings, profit per share. Now think about it, and then at time one, then our equity at time one is basically equity at time 0 plus EAT at time 1. And we know in dollars it is $8 million, right? $8 million. But think about it. Then if we divide it by number of shares, we divide it by still 1 million shares, because their number of shares is still 1 million, right? And then you divide it by 1 million shares. This becomes what? $8 per share. Ah. No, what happened? What's happening? $8 per share. So this is what? This $8 per share is called that's book value per share at time 1. Isn't that right? That's book value per share at time 1. And then if you think about it, it's exactly coinciding with it. Book value per share is only, equity at time 1, divided by number of shares. So in other words, we arrive at the same conclusion. Book value per share at time 1 is exactly book value per share at time 0 plus earnings per share at time 1, which coincides with equity at time 1. Look, the only difference is equity at time 0 plus EAT at time 1. The only difference is that this is just per share concept, per share, right? In other words, if you divide all of this by number of shares, then you arrive at this, right? You get that? Alrighty, so right? As you divide okay, the computer is not. You divide all of this by number of shares, then it becomes this, right? It becomes, right, per share concept. So that's book value. Market price will be market price can deviate from it because market is always swayed by a lot of noise. Okay, so we're out of time. 10 minutes passed, so I'll have to say goodbye here. I will see you guys all on next Tuesday. So this wraps up everything about topic 2. Okay.
Bye, Professor.
All righty. All right. Take care, everyone. Have a great afternoon.
Have a good one.
Stop sharing. All right. You take care and stop recording and